Hello everyone, in this video I'm going to be talking about profit maximization. Right here I wrote the key points that you need to understand after this lesson. So profit maximization is going to happen where marginal revenue equals marginal cost. In a perfectly competitive market, we're going to be wrestling with perfectly competitive markets today, or with firms operating in a perfectly competitive market. Marginal revenue is going to be the price. And then finally, firms are price takers in a perfectly competitive market. We'll talk more about perfect competition and the features and characteristics of perfect competition next week. Okay. So I'm going to go ahead and graph the cost curves. Don't worry about this star review. This review material, I'll try to link it together as I draw the various different cost curves that we've been trying to understand over these last few weeks. But I want to be clear about something, so I'm going to be drawing the cost curves of a coffee shop. I'm just going to put a random coffee shop. It could be anything in the short run. Right, so we're going to say there's a lot of assumptions that I'm going to build in this graphical model. I'm going to graphically show you where profit maximization is going to occur and kind of the logic, the geometry, so to speak, of these core ideas. And we said in the short run there's that important assumption. There's about factors of production. In the short run, we hold one input in the factor of production. So this is going to be the first key point. One, and I put a star because this is review, right? And then I'll write out the introduction to new materials, introduction to new material down here. But in the short run, one factor of production is going to be fixed, and the other factors of production will be variable, meaning easily changeable. But we hold one factor of production fixed, and this has implications for the shape of our cost curves, and we'll talk about that right now. So first, let me draw our cost curves. On the y-axis, we have the price / quantity, and then on the x-axis, we have quantity or output, or the number of cups of coffee. So I'm going to draw my average total cost curve. It's going to look something like this. Draw my average variable cost curve, something like that. Now I'm going to draw my marginal cost curve. I'm going to draw a little hook, and I'm going to explain the significance of this in a bit. And I don't know if I did a good job, but your marginal cost curve is supposed to cross your average variable cost and average total cost at the minimum points. Remember, we said that's an important features of this short run cost functions. Okay, and so the next point too, the next critical point, this should be review. Average total cost, the distance between average total cost and average variable cost is going to be average fixed cost. If we actually drew the average fixed cost, it would be downward sloping, and it would hug the x-axis. It would be a horizontal asymptote. And the idea behind that is your fixed cost is something that doesn't vary with output in the same way variable cost does. And so you would just be dividing your fixed cost by increasing quantity of cups. So your average fixed cost is just going to get smaller and smaller and smaller. Okay. Average total cost, average variable cost. And this also explains why average variable cost almost seems to start to catch average total costs, right? Marginal cost crosses at the minimum points of average variable cost, average total cost, and then begins to pull them up. That important word marginal, it's one of the most important words in microeconomics, and I guarantee you that if you use it, I guess as you talk to friends or your family or on a date, you're going to sound really, really intelligent. But marginal, think of using additional twice. So marginal cost would be the additional cost associated with an additional unit of output. Okay. Another key feature that I want to point out in this depiction specifically, so we can actually kind of almost divide this marginal cost function into two parts. And we could say at the first part, well, actually it would be closer down here. At this first little part here, we have like a downward sloping curve. I don't know if you can see that. And that's downward sloping because diminishing marginal product hasn't kicked in. So maybe initially we get increasing marginal returns. And so that's what that would represent. This little downward sloping part would represent that. Initially we get increasing marginal returns or increasing marginal product. And the idea is that our marginal product, remember, is the additional product associated with an additional unit of output. And then as your marginal cost curve begins to becomes upward sloping, this is where the law of diminishing marginal product kicks in, or decreasing marginal returns kicks in. This is where we would expect it. And we are going to say that this is going to be a short run phenomena. This is a short run phenomenon, right? If you hold one input in the factor of production fixed and the other variable, as we do in the short run, in the long run we say everything is variable, but in the short run, one input in the factor of production is fixed, then we should expect diminishing marginal product, right? Meaning the additional product from an additional unit, or the additional product from an additional unit of labor is going to be smaller at some point. And it doesn't necessarily have to kick in right away. That's where this little hook happens in the marginal cost curve. It could, right? I mean, if it did, we wouldn't have this part of this function. We would just only have two. But we would expect diminishing marginal product to kick in at some point. And the logic behind it is we run through the coffee shop example. If we continue to add baristas, because we can't just like, capital is fixed. We can't just say we want to increase coffee production, so we're going to create another Starbucks. If we add, like 10 baristas, they're going to start bumping into each other. There's going to be some that are goofing off because they literally can't work in this tiny space. So we expect diminishing marginal product to kick in, and therefore decreasing marginal returns. And that explains why our average total cost curves and average variable cost curves look the way they do, and then slope upwards. Right, so increasing marginal costs. Okay, so that's significant, and that's going to be significant, but it doesn't tell us where is the optimal point to produce. If you're trying to maximize profit, and here's where the I&M comes in, so I guess I'm going to put this in green. This will be the introduction to new material. This is going to be the intro to new material. And so the first thing we have to know is, what is profit? We've talked about this before, but profit equals revenue minus costs. Today we're going to talk a lot about total costs. We're going to ignore average variable costs, but we're going to bring that in later next week. So profit equals revenue minus costs. Everyone see that? And revenue, we said, is price times quantity. That's revenue. Okay, so profits equals revenue minus costs, and revenue is price times quantity. Should I come over here? Should I don't know. And this idea that profit maximization is going to happen where marginal revenue equals marginal cost. Okay, what's our marginal revenue curve? Okay, so I'm going to tell you what that is. Well, we're going to assume perfect competition. We're going to assume perfect competition, and I've said this before, it's an extreme, but in economics, we oftentimes try to think about extremes, so that way we can later examine the range of possibility that exists between those extremes, or develop intuition and ideas about the range of possibility that exists between those extremes. So we're going to assume perfect competition, a perfectly competitive market. And one of the things about a perfectly competitive market, we're going to develop these ideas next week, is that firms are price takers, right? So whether the demand for whatever good those firms are selling is, relatively inelastic or not, the demand for a firm's individual individual goods, the demand for the individual goods of a firm will be perfectly elastic. Meaning if you raise the price in a perfectly competitive model, you'll lose all your business. We've talked about elasticities before, right? So we're saying firms are price takers. And so revenue is price times quantity, right? That's going to be the revenue that a firm gets. So it's going to be price multiplied by the quantity. But we're going to assume that in this model, that firms are going to be price takers. Price takers. And so this is going to be important, and it's going to help us because we can actually draw the price. If we're given the price, let's say it's going to be the price is $4 per cup. I'm going to say this is the price. I'm going to say this is $4. That's the price. Now, this price is the same as your marginal revenue curve. Right, you're a price taker, right? You can't vary the price, right? Now costs vary, which is what we found out. That's why they're curves. Now price or your marginal revenue curve is just going to be horizontal. And think about it. Marginal revenue reflects the additional revenue you get from an additional product, right? So the additional revenue you're going to get from adding an additional product is always just going to be the price, right? If you sell one more unit of coffee, the marginal revenue is going to be $4. It doesn't mean you should continue producing. Obviously, you have to take into consideration your costs, and which is what good firms do. Profit maximizing firms, which we're assuming firms that are rational and profit maximizing, want to take into consideration their costs. And so the place, or the profit maximizing place that I'm going to show you, this is, I guess, suppose a geometrical depiction, is right here. So where marginal revenue equals marginal cost. That's the point at which profits are maximized. And I'm going to flesh out this intuition geometrically. So let's say that this is 20 cups of coffee, $4 per cup. We can calculate the revenue, right? 20 times 4 is, the total revenue is 80 bucks. I can actually draw the area that represents the total revenue pretty easily, maybe not in pink, let's say green, right? This should be a straight line. It's not very straight, but sorry about that. Let's say in green, this is going to be the total revenue. Everyone see that? So green is going to represent the total revenue. Now, of course, this can also help us find out what would be the profits, right? So the way we can find out the total profit is we can go down to the average total cost curve and then create a straight line across whatever that number is. Let's say it's $3. So the average total cost is $3 per unit of coffee. And despite the fact that coffee, or each cup of coffee costs a different amount, right? This is what these curves mean, right? It's not just a horizontal average total cost curve. This can allow us to geometrically understand that at $3, everything below this point is going to be costs. Right, so 20 times 3 is going to represent 60 bucks, and that 60 bucks is going to be a cost. Right, so your profit is actually 80 minus 60, which equals 20 bucks, right? That's what your profit will be. Your profit, we can represent it. I'm going to put pink hashtags going this way. Your profit would be all of this. Now let's think about this let's think if we produced greater than the point where marginal, or less than the point where marginal cost equals marginal revenue. Well, if we did, let's say we produce at 18, it would be the same idea. Move over the, find that intersection to find the actual profits, and we would see that we would be leaving this little chunk of profits behind. I mean, we'd still be profitable, but we'd be leaving a big chunk of profit behind, right? A big chunk behind. So we wouldn't be profit maximizing. Let's say we produce greater than where marginal cost and marginal revenue intersect. Let's think about that for a moment. So we produced at that point, so 22. This would be like producing an additional cup of coffee, even though that additional cup costs you $6. So obviously it's going to eat into your price. And though initially you'll probably extend this peak hashtag area further to the right, you're going to lose a large portion of the bottom of this rectangle, right? And I bet you if you compared the areas, you would find that your profits that you earn from selling 22 units is going to be smaller than selling 20 units. Now, if you or struggle with this interpretation, this geometrical, I suppose, analysis or whatever, here are the key points you need to know. Profit maximization happens when marginal revenue equals marginal costs. In a perfectly competitive market, marginal revenue equals price, and firms are price takers in a perfectly competitive market. Now we're going to click this. We can look at another example in which we are given data about short run costs and revenue functions of lipstick. I drew on this one. This one is from my last period class. And so this is short run. So we have a fixed cost. We're holding one factor of production fixed. Variable costs, it's going to be, you can see the variable cost. Total costs is the sum of fixed and variable costs. Then we're probably going to need to calculate marginal costs. A lot of examples are going to require you to calculate marginal costs, and you do this by finding the distance between these two figures. So the marginal cost is the additional cost from an additional unit of output, so additional lipstick, so 15, 7, 10, 13, 18, 22, 35. We could see that diminishing marginal returns kicks in at the third unit. Right, we can see initially the costs is decreasing from 15 to 7, and then they start increasing all the way. So we get diminishing marginal product or diminishing marginal returns. Both happen at the third unit. But that's not what we're looking for in this example. Marginal revenue, they'll give you the price, and I'm just going to assume the price of lipstick is $25. And since you're a price-taking firm, you can't modify the price, you can't discriminate. So $25 all the way down. And then your profit maximizing point is going to be the 6th lipstick, as we can see here. It's not going to be the 7th. If you tell me, Mr. Diaz, but what the heck? You said marginal revenue had to equal marginal cost to maximize profit. I know, I'm not an idiot though, but try selling half a lipstick. I mean, maybe there's ways that you know, or maybe with certain types of products, it's more feasible to think about the distance between those quantities. But as we can see here, 6 is the point at which marginal revenue comes pretty close to marginal costs, 22 to 25. At the 7th one, marginal cost is $35. Marginal revenue is 25. So 6 is the profit maximizing point. You don't believe me, actually do these calculations, right? This is the profit that you'd get, negative 26, negative 2, negative 13, 25, 32, 35, and then $25. So you can see 35 is the biggest, it's the profit maximizing point. We can also see we initially start with negatives. That's this idea that we have fixed costs that we need to take into account, right? Fixed costs that matter, right? and we're paying them off with increasing output. We can also see diminishing marginal product setting in here, right? Because the increase in profit starts to falter at the third unit, right? We can see that. We can calculate the marginal profit or marginal revenue. Or we can calculate the marginal profit. And then marginal revenue right here. Oh, and the way that you calculate profit is you multiply the revenue, 25, times the quantity, 1, 25 times 2, whatever, and so on and so forth, minus the total costs. And then that's how you calculate the profit. All right, I hope this was helpful.